Assalamu alaikum. Welcome to lecture 13 of tax. This is the continuation of lecture 12 where I've introduced you to capital gain tax. So we were calculating chargeable gain, the basic calculations. Now from there we are moving on to chargeable gains on chattels, land and buildings. So disposal of chattels and vesting assets. You have been introduced to chattels and vesting asset in lecture 12. Now we are going to go in detail in the calculation part. The terminology, chattel, vesting asset, then disposal of land, part disposal, private precedence relief. You have come across this term in the previous lecture. Now you will know in detail what is this relief and how it works. Part disposal means when you are not disposing the entire land or buildings, part of it. Then when an asset is lost or damaged, loss or destruction, damage to non-vesting assets. Remember, loss and damage, they are treated separately. They are not the same thing. Loss of asset is something else, damage of asset is something else. And finally we are going to conclude which part of the syllabus did we cover, summarize the entire lecture, and then technical articles. Are there any technical articles available on this lecture? Now, so this is the graphical representation of what I've just gone through. Disposals, it is divided into three parts. Chattels and vesting asset is one part, land and building is another part, and lost or damaged asset is another part. Now, so what is chattel? You have heard this word, but you don't know what is chattel. Chattel is your tangible. Remember, it's tangible because for intangible we have another set of rules. Chattels are all your tangible and movable property. You will be able to move them. That's why land and buildings are separate, because you cannot move land and buildings. Chattels you can move. You can touch them also. So they are tangible and movable, like your furniture, vehicle, jewelry, animals. Okay. Now, next, vesting asset. Vesting asset means assets with a predictable useful life of 50 years or less. Okay, this was explained before. Now, so when we are disposing chattel, so already stated in lecture 12, chattels are exempt asset if these conditions are met. So, if they are vesting assets, cars, or has market value and the cost less than 6,000, and do not qualify for capital allowance if they fall under plant and machinery. So these assets are exempt chattels. Okay. Now, so the computation of gain or loss on a non-exempt chattel depends upon the relationship of your proceed and the cost, the 6,000 limit. There are four situations which are possible for the chargeable disposals of chattels as follows. Now we'll see this. So look at this diagram. Okay, there are four situations. First we'll go through situation number 1, where your proceed is more than your proceed, both your gross profit and your cost, selling price and your cost both are more than 6,000. So normally it is chargeable. Okay, normal chargeable gain or allowable loss will be calculated. Second situation, gross profit and cost both are less than 6,000. So that gain or loss is exempt. See, in the first situation, both are more than 6,000, chargeable. In second situation, both proceed and cost are less than 6,000, exempt. Situation number 3 and 4 is little tricky. Not tricky, but here you have to work. 3, your proceed is more than your cost. Okay, proceed is more than 6,000, cost is less than 6,000. As you can see, this 6,000, you see, proceed is above 6,000, cost is less than 6,000. So in this case, it is chargeable, but there is some marginal relief. When your gross profit is more than 6,000, okay, SP more than 6,000, cost less than 6,000. Normally it's chargeable, but there is a marginal relief. There's a marginal relief. This was not there in situation 1 or situation 2. Coming to situation 4, the last situation. Now you see it's the other way around. Your cost is greater than 6,000. Sale proceed is less than 6,000. If this happens, you can see it's a loss, allowable loss, but this loss is limited to a reduced amount. Okay, so now we shall see that when we do questions. Now, so in situation 1, both are greater, normally chargeable. Situation 2, both are less than 6,000, completely exempt. Situation 3, proceed is more than 6,000, cost is less than 6,000, gain will be lower of the gain and the this 5/3. Remember this fraction 5/3 is fixed. This is applicable for situation 3 and 4 only, the 5/3 fraction, not 1 and 2. So 5/3 into gross profit minus 6,000, whichever is the lower, that is chargeable. Gain normally calculated and 5/3 of gross profit minus 6,000, that means the gain. Now situation 4, sale proceed is 6,000, less than 6,000, cost is greater than 6,000. So this allowable loss, okay, is restricted by substituting the deemed gross profit of 6,000 for actual gross profit. Can you understand? Instead of your actual gross profit, which was less than 6,000, you are putting 6,000 as the profit in that place. This is how you are going to get the relief. So relief is still given for the actual incidental cost of disposal also. You are getting the relief. Now, activity 1. A, you have to calculate chargeable gain. B, you have to calculate chargeable gain if your sale proceed were 11,500. Here, enter table for 2,500. Then she sold it for 6,500. You can clearly see cost is less than 6,000. Selling is more than 6,000. But the 6,500 is before deducting the selling cost of 100. Now, let us do activity 1. So, part A, we will be calculating the gain. Okay. So the sale proceed is 6,500 deducting the selling price. So 6,500 is the sale proceed. We deduct the cost and we have the net sale proceed. So 6,400 is your net sale proceed. From here we are going to deduct the cost 2,500 and use the sum function is 3,900. This is your gain. We'll put this as A. Okay. Now, see, remember, lower of A and B. Why? Because this is situation number with situation. Situation number 3. Sale proceed is less than 6,500. Sorry, sale proceed is more than 6,000. Cost is less than 6,000. This is situation 3. You have to use the fraction 5/3. So this is A. Lower of the two will be your gain. Now, so we are going to take 5 divided by 3, multiply this bracket, put it in the bracket. What is your sale proceed? Gross sale proceed. Gross means you have to take 6,500 before deducting 100, not your net sale proceed, minus the 6,000. Remember, in terms of your cost 2,500, you will put 6,000. You will replace it with 6,000. Okay, so we are going to drop down the 0 decimals. 833. B. We'll take this as B. So chargeable gain will be lower of A and B. So it's B. It's 833. This is lower. Now, let us move to part B, where your sale proceed is 11,500. Gross sale proceed. Okay. So now, what happens? in terms of 6,500, I will just change it to 11,500. Rest cost, everything remains same. So now it's 8,900 and moving to B. So when I go to B, just change this to 11,500. That's it. This time what is lower? This time A is lower in B. Okay. Now activity 2. Now we are selling it at a loss. So Sarah purchased an antique chair, cost 7,000. She sold it for 4,000. Expense of silver 240. So if you see, she sold it for 4,000, less than 6,000, and cost is more than this one. This is situation number 4. So we'll do activity 2 now. Okay. Now remember, she sold it for 4,000. So instead of 4,000, we'll put 6,000. That was the rule. Okay. Then the cost here is 240. This is activity 2 I'm doing. Okay. So now you get your net profit 5,760, and from here your cost will be 7,000. So the loss is 1,240. That's it. This is how you calculate the allowable loss. So this is the answer. We have just calculated. And then this is the answer for activity 2. We have calculated the allowable loss. Instead of the actual proceed, we have put 6,000. Now, moving on to vesting asset. So that one was for chattel. Now coming to vesting assets. Vesting assets means useful life is 50 or less. There are 3 kinds of vesting asset. First kind, chattels not eligible for capital allowance, exempt from CGT. Chattels eligible for capital allowance and other vesting assets. So we'll go through other vesting assets first. Other vesting assets that are not chattels. Example, your copyright. See, chattel has to be tangible. Vesting assets could be intangible also. So other vesting asset means it includes intangible assets like copyrights. They are chargeable assets. We have covered this in lecture 12, right? Chargeable assets. Now, so how do you compute? The computation of gain or loss. That means we compare the sale proceed with the cost. So in terms of copyright, remember copyright is an intangible asset. It will be having depreciation. The cost will depreciate. So we have to take that part there and deduct it from the cost. Okay. So we compare the sale proceed with the unexpired cost of the asset. The cost that was not expired. Okay. So the unexpired or allowable cost, you can say, that you can deduct from sale proceed is this. You have to remember. Remaining number of useful life at disposal divided by the total estimated useful life into the cost. So now example 1. You see, you are selling a copyright for 24,000. Purchased it for 30,000. Remember, this 30,000 straight away you can't take. Okay, you only have to take the unexpired portion. So what was the useful life? 40 years. Okay, what is the remaining useful life? From 1st September 2011 it was 40, but when you came to 2024, how many years went by? From 11 to 24, 13 years. So total 40, 13 years went. From 40 we deduct 13, you are left with 27. So 27 over 40 into the cost. Deducted, and this is your gain. Simple. Now, second category, chattels that are eligible for capital allowance. Okay. So where your capital allowance has been claimed. By the way, capital allowance lecture I have covered in lecture 7. Okay, the full calculation. Please go back and watch it. How to calculate. So capital allowance is where it has been claimed, which is later disposed. Okay, so gain and loss must take account of the tax relief already provided through capital allowances. Now, where the asset is sold at a gain, normal gain, you must have calculated. Applying the 6,000 rule if it's applicable. And any capital allowance which have been claimed will be clawed back with a balancing charge on disposal of assets. Remember, when you're disposing, okay, in your capital allowance calculation, I have shown that when you are selling, a balancing charge might arise. This is when you are selling it at a profit. When your sale proceed is more than the tax rate return value. Okay, that means the benefit that is given to you in capital allowances are now being taken from you through balancing charge in your capital allowance itself. Now, when the asset is sold at a loss, so that loss is restricted since the tax relief has already been given through capital allowances. Okay, so in your capital gain computation, the net capital allowances, that is the net of balancing charges on disposal, must be deducted from the allowable expenditure. As such, plant and machinery which is eligible for capital allowance and sold at a loss result in a no gain, no loss disposal for CGT purpose. This is what you have to remember. When you are selling a plant and machinery at a loss, which was eligible for capital allowance, for your CGT purpose, it is at no gain, no loss disposal. Okay. Now, so example 2 will help you to understand this. Now, you are purchasing a machinery for 20, you sold it for 25. So from 25, if you deduct, the gain is 5,000. Okay. So because this is a machine, it was eligible for capital allowance. Okay. This capital allowance that was claimed will be clawed back as a balancing charge. That means that balancing charge will be deducted from capital allowances. What is this balancing charge? If you're not understanding this term, you need to go back to my lecture 7. Okay. Now, example 3, when you are selling it at a loss. Now, cost remains the same, but you are selling it for 15. So 15 minus 20, there's a loss of 5,000. So, the capital loss computation is adjusted to reflect the loss already given through capital allowance, like this. You have 15,000, right? Remember, it is at no gain, no loss. How it is at no gain, no loss? It is shown here. The cost is 20. So from this cost, you will deduct capital allowance that was already claimed. From where? From the cost. This is always the rule. Whenever capital allowances are claimed, deduct it from cost. So now it's 15,000, right? So 15,000, if you deduct from 15,000, you see, nil. Now, disposal of land and buildings. So we finished the first category, chattels and vesting assets are over. We are moving on to land and buildings, the second part of this lecture. So for your tax, land and buildings can be your freehold land. Freehold means you are owning it, or leasehold. But lease, short lease, 50 years or less than 50 years, not more than 50 years. Okay. Then for your CGT, an area of land and the buildings located thereon are treated as a single asset. That means the building where you're having a land, for your CGT purpose, it is treated as a single asset. Now, land and buildings could be used for personal or business purpose. Okay. So accordingly, it will reflect the CGT treatment. If your land and building is used by the taxpayer, that means it's the taxpayer's home, it's their private residence, they are staying there, then from CGT it might be totally or partially exempt. This will cover in section 2.3. And if it's used for the business purpose, then any gain arising on that, okay, still they will get another relief, not private residence relief. If it's a business purpose, they will get other kind of relief, like business asset rolled over relief and gift hold over relief and business asset disposal relief. This will cover in lecture 15, where we are covering all the reliefs that you can deduct from your CGD while you're calculating CGD. Business asset, because land and buildings when used for business purpose, it is treated as business asset. Okay, business asset rolled over means, briefly I will explain you. Detail will be explained in lecture 15. Just in case you might be blank out now, confused what is this reliefs and how it works. See, business asset rolled over. It is also known as rolled over relief. Okay, means land and building when you are having it. So, but since it's used for business purpose, okay, when you are selling a land and building, and the proceed that you have received while selling land and building, you are using it to buy another land and building. It's like you are replacement. So since you are replacing it with another land and building with the proceed used from the first sale of land and building, first time you are selling land and building, you will not be charged to CGT. It's deferred, it's rolled over. See, you are not exempted. For time being, you're not paying the tax. You're going to pay it in the future. Time being, it is rolled over to the next disposal. Until, so you can keep on rolling over like this until finally you sell a building or a land, and then you don't replace it with another land and building. That means you are not buying another land and building. You finally sold off. That time you have to pay the tax, CGT. Okay. So it is known as business asset rolled over relief. Then gift holdover relief. Gift means when you are gifting it, you can claim gift relief. That means the donor does not pay the tax. Donee, the one who is receiving the gift, has to pay the tax if the donee later disposes it. Remember, there should be a disposal. Just having land and building, you don't have to pay CGT. Only when you are making a gain, okay, then the CGT arises. Like how when you receive the income, you have to pay income tax. Same way, when you incur the gain, how do you incur the gain? Only when you dispose. It could be any type of asset: land, buildings, vesting, chattels, vesting assets, shares. Okay, and to reduce that gain further, how we deduct taxable income? There were so many reliefs, right? Loss relief, qualifying donations, charitable donations. Same way, for capital gain tax, we have various type of relief. One such asset reliefs are business asset relief. Some reliefs. There are three categories of reliefs that we will be covering in lecture 15. Briefly, I will introduce here. One category reduces the rate of CGT rate. One category exempt it from CGT completely. The other type of reliefs are those reliefs that does not exempt it but defer your gain. Rather than paying now, you have to pay in the future. So one such relief is business asset rollover relief and also gift holdover relief. These two works in the same way. They are deferral reliefs, you can say. And then third one, business asset disposal relief. This is when you are using it for when you are selling a business asset. Like this land and building is for business purpose. So here what you have to do, the rate, rather than paying 20%, you pay 10% for all the gain. If it is treated as business asset disposal relief, you are paying a lower CGT rate, that is 10%. Only 10%, not the residential rate. No, because residential property are not taken as business asset. Okay, only the other assets. So you pay the rate at 10%. You reduce the CGT rate. Okay, I hope with this brief understanding you somehow understood this, and later it will help you in lecture 15 also. Now, so the chargeable gain will also be affected when there's a disposal of a building on which SBA has been claimed. This also I've covered in lecture 7 in section 2, 2.14. Make sure that you revisit my lecture 7 in case you want to know again how this works. It is just 3% on a straight line basis, for which capital allowance was not claimed. So when you're disposing of building on which SBA is claimed, chargeable gain will be affected. Now, disposal of leasehold property are excluded from the syllabus. Thank God. So you don't have to worry about it. Now we are moving on to the part disposal. This is a very, what do I say? An area which examiner often test in your exam. I often see this area coming in your exam, appearing in almost all the settings. Okay, so make sure that you are very well uh, revise this area, part disposal. Okay, for example, land sometimes you use as a part disposal. Now, where a part of an asset is disposed, you have to calculate how much of the original cost of the asset relates to the part of the asset that is being disposed of. Then you calculate the gain and loss by comparing with the net proceed of the part that is sold. So how much of the cost you have incurred to sell the part and the amount of the part that you have sold. Compare these two and calculate the gain. There's a fraction for part disposal. This formula you need to remember. This is the attributable cost of the part disposal. Cost into A divided by A plus B. What is A? What is B? A is your gross consideration. That is your open market value of the part that is sold or given away if you have given it as a gift. Whatever. This they will give you in the question. Both A and B will be provided to you, also the cost. You just have to use the formula. B, market value of the remainder of the asset at the date of the part disposal. So this formula is not attributable to any cost which relates wholly to the part sold, which is deductible in full. What does it mean? If the cost was wholly to the parts sold, remember, you don't need this fraction because then the entire cost you can deduct from the amount sale proceed. Okay, the cost not attributable to the part disposed will be applied for the later disposal of the remainder of the asset. Remember, the cost that now you're not attributing to the part disposed will later you will use it for the later disposal of the remainder of the asset. Now, activity 3, you have to calculate the two chargeable gains. So now let us do that. Here, he's selling a land in two transactions. One part in July, the remainder in Feb. Okay, so this part is for the first part, this part is for the second part. So cost has been given, it includes the incidental expenses in it, 18,000. Then gross consideration is given, expenses of disposal, market value of remainder. And then net sale proceed, cost of obtaining planning permission. Everything is given, now use the formula and calculate the gain. So let us do that. First, we are going to calculate the chargeable gain, okay, acquired in August 2013, which was sold in two parts. One in July 2024, other one Feb 2025. So first the July 2024. Okay. Now this time it was a part disposal. So first is the consideration. It was 21,000. Then we deduct the expenses. Expenses were 1,200. Now we'll be doing a sum function. Then we will be deducting part cost. Here we have to do the fraction. This is the place where we have to do cost into A plus A divided by A plus B. Okay. So now equal to minus, what is the cost given? 18,000. 18,000 into A divided by A plus B. What is A? Your gross consideration, that is 21,000. Divided by 21,000 again plus B. What is B here? The market value of the remainder, which is 31,500. So we'll close the bracket. What happened? Here we have to put the bracket. Okay. So it is minus 7,200. This is part cost. Now the sum function. So 12,600 is the chargeable gain. Okay, now coming to Feb 2025. So we'll change this to Feb 2025. This is not a part disposal. This time it is the disposal of the remainder. So what is the sale proceed? 68,000. The net sale proceed is 68,000. So from 68,000, what do we do? Remember this 7,200, we need it. Keep it somewhere outside. Okay. So less the cost of the remainder. Okay. So what is the cost normally? 18,000. And from 18,000, for part cost you have taken 7,200. So when you are taking the cost here, okay, you have to take 18,000 minus 7,200. So minus 10,800. Now, what's next? Cost wholly attributable to the remainder. If you see, so the cost of obtaining the planning permission, this 5,000 is wholly for the October cost only. Minus 5,000. Now, the chargeable gain is simple as this: 52 to 100. So this is the answer we have got. For July 2024, it was 12,600, and here it's 52 to 100. Now, moving on to the next, which is your PRR, private residence relief. So under this relief, your basic, your home, the private residence of the taxpayer is exempt. When you're disposing your private residence, it is exempt. If either it was occupied by the owner throughout the period of ownership, or it was occupied by the owner at some time during the period of ownership. That means it has some period of ownership, some period of non-occupation where owner went somewhere else, did not stay. And some, there are deemed occupation. That means they are considered to be occupation. Actually, they are not occupation. What is this deemed occupation? We'll see this. So, the private residence can be your house, it could be an apartment, a mobile home, or even a houseboat. And the exemption includes property and the garden up to half a hectare. If the taxpayer is married, remember the couple can only have one PRR. Even the couple are two separate taxpayers, both of them will have only one PRR. If the taxpayer purchases second home, okay, which is not a replacement of the first home, then you can make an election to treat your second home as your PRR. But remember, the election should be within 2 years. Within 2 years of the date the second home is acquired. Okay, to determine which home is to be treated as your main residence for PRR. Remember, only one home at a time could be your main residence for PRR, not two. And remember, if election is not made, if you are not making the election, HMRC will decide when one property is sold, which one will be PRR. Now, calculation of the relief, how it is calculated. So when there are no period of absence from the main residence, what happens? The entire amount is exempt from CGT. That means you have been staying in that property throughout. You were never absent. So whatever is your gain, that is equal to your private residence relief. That means entire gain is exempt, which is the best. But sadly, that rarely happens. Okay, and rarely you will get such a question where the owner is staying throughout. No, there will be a period of absence. So when there's a period of absence, your private residence relief is restricted. That means it will reduce. And once you reduce your chargeable gain by the private residence relief, the excess, what is left, will either be taxed at 18% or 24%, depending on whether the taxpayer has any basic rate band remaining. Now, So this is how a chargeable gain is calculated when there has been a period of absence. You calculate the gain, net sale percent less cost and any enhancement expenditure. Take the total period of ownership in months. Take the period of occupation. Also in that occupation, deemed occupation also you have to add, and non-occupation. This we will cover in the next section only. And calculate PRR. So your gain into periods of occupation divided by total period of ownership. This is your gain. Then you calculate chargeable gain by deducting that PRR from your gain, original gain. Now, non-occupation, where the owner did not stay. So okay, for some occasion, your non-occupation will be treated as you were occupied, deemed occupation. Okay, they are. Remember these points very well. The last months of ownership, they're always exempt. Remember, whether you stay in the last month or not, the last month of the ownership is always exempt. Always. And provided actual occupation precedes and follows absence or aggregate absence. That means you have to stay before that also, and you have to come and stay after that period also. After that absence, you have to come back at least stay in that property for 1 day for it to be taken as a deemed occupation. Okay. So for this, these are the areas where before you have to stay there, then you get absent in between, then again you have to come back and stay there. So after you're absent, you have to come and stay there 1 day. Before the absent also you have to stay. Then only it will be counted as deemed occupation, but not for all the situation. Situation is given. Situation number 1. Any period where the taxpayer was employed abroad. If the taxpayer is employed abroad, okay, any period you can take. Then second, period should not exceed 4 years. Due to having to work away from home, you are working from home, it should not exceed 4 years. That means 48 months if you are taking. Remember, you have to take in terms of months. 4 years means 4 into 12, 48 months. Either because you are working away from home, either because you are employed or self-employed. Could be in UK or abroad. Then third, for any reason you are absent. But it should not exceed 3 years. It should not exceed 36 months. But if the period was employed, a taxpayer was employed abroad, for how many months does not matter. There is no time limit to it that he has to stay there for this month. But if you see point number 2 and 3, 2 is for 48 months, 3 should not exceed 36 months. But point number 1, any period. It could be for any number of months. The entire amount is exempt. Now, so the requirement to have an actual occupation after absence is dropped if reoccupation is prevented by reason of taxpayer's employment. See, if taxpayers are employed abroad, it's not possible for them to come and reoccupy after being absent. That's why that condition is dropped if the taxpayer is employed abroad. They should not actually come and occupy after being absent. But for other reasons, they have to occupy. That means actual occupation has to be there after the deemed occupation. Now, exam advice. Although explanations are not required in your exam, they will not ask you. But it's best to include a brief explanations for periods of deemed occupation in PRR questions. See, mostly you have to calculate the number of months you have been absent, you have occupied, deemed occupation, and then you have to calculate PRR. This is what they will normally ask. The discussion part they normally don't ask in this area, the calculation part. So let us do activity 4 with non-occupation. You have to calculate the chargeable gain arising on the sale of the house. So on 1st June 2005, they bought a house for 50,000, which he sold for 305 on 1st June 2024. On 1st June 2016, Parikal moved in with his sister and the property was unoccupied until the date of sale. So from 1st June 2005 to 1st June 2016 only he was there in the property. After that he did not stay. So now let us calculate the PRR when the taxpayer was absent after 1st June 2016. So whenever you are given a question with PRR, okay, you have to write the date, you have to write whether actual occupation, deemed occupation, or absent, then the exempt amount, exempt month, the chargeable month, and the total. So total 5 columns you always need for PRR. Keep this in mind, it's fixed. This 5 columns is always required, no matter what. So first he occupied from 1st June. Okay. So always write the date. This will help you. It's like a timeline. From 1st June to 31st May 2016, because 1st June 2016 she moved out. 31st May, that's the last day, 2016. Then remember the last 9 months, they are taken as deemed occupation. So take the last 9 months out. When are you selling it? June. Okay. So from June 2016, go 9 months back. Jan to June is 6 months and another 3 months from 2015. So it is ending on, so the last 3 months of 2015, October, November, December makes 9 months. That means from 1st September. The last month is taken from 1st September 2015. September, October, November, December. And January, February, March, April, May. So this, if you are unsure in the middle part, at least take the 9 months. The last 9 months calculate first. So this will be 2023 to 31st May 2024. So now it's easy. The remaining part, 1 June, 1st June 2016 to 31st August 2023. Okay. So here you have to write the reasons. Here you actually occupy, so actual occupation. Okay, here this is last 9 months. Last 9 months is deemed occupation, and here absent. So then exempt. These are exempt months, these are taxable months. Keep them separate. And total. So actual occupation will be exempt. How many months? From 1st June 2005 to 31st May 2016. So because the months are same, it is just the years you have to calculate. From 2005 to 16, if you take, it is 11 years. Okay, if you want to convert it 11 years into months, it's very simple. Just take 11 into 12 months, 132 months. Okay, this is the last 9 months also will be exempt. So since it's a 9 months, it's already in months, so 9, and then this absent. He moved with his sister. Okay, that is the reason he's absent. But remember, there were 3 reasons why he could be absent. He was not employed abroad. Okay, otherwise the whole thing would be exempt. Next, he was employed abroad or in UK and he couldn't come. Okay, so this could be your third situation where he could be absent for any reason, but it should not exceed 3 years, 36 months. Even that 36 months would have been exempted under this, but the reason is he did not come later and stayed there. Actual occupation did not take place after this absence. That's why the whole thing will be taxable. Okay. Remember, 3 years he could be absent for any purpose rule. So this falls under that, any purpose rule. Otherwise, they would have told he was occupied somewhere else, he was working somewhere else. Okay. So this is situation number 3. Any years means 36 months. So no period of actual occupation took place after absence. The whole thing is taxable from 16 to 2023. How many months? 7 years. Okay. So it's 7 years. But if you see the months from June, you have to take June, July, August. Another 3 more months you have to add with 7 years. How are you going to do it? 7 into 12. Because 7 years, 12 months. And then you add another 3 months to it. June, July, August. 87 months. Okay. So here the total is 132. Here it is 87. And here it is 9. The total is, do the sum function. And here sum function. And here it is just 87. So now when you're calculating PRR, okay, remember, so we start with the proceed. What is the proceed? 305,000. Take the cost. What is the cost? 50,000 minus 50,000. So take the sum. Now from here you have to deduct your PRR. Okay, so when you're deducting your PRR, how are you going to deduct your PRR? Minus this. Okay, on this you multiply exempt amount. Remember, exempt amount, PRR is exempt, divide by the total. Enter. So this number is in decimal, just drop down the decimal. Okay, this is your PRR. Now what you get is your chargeable gain. So we are going to drop down the decimal. 97,303. This is your chargeable gain. So this is what we have exactly done. We have got this as the chargeable gain. Now, letting relief is the next relief. But for letting relief, you have to calculate your PRR. Without this, you can't calculate letting relief. Letting relief is when in the taxpayer's main residence, they are letting part of it for residential use. Okay, the main residence was for residential use. That they are letting to someone else. So the part that has been let off, they can get letting relief. But remember, the taxpayer is still occupying the remainder of the property there, not letting the entire thing. Okay. But if the whole property is let out, letting relief will not apply. And even if the property is not the owner's main residence, then in that case also letting relief will not apply. For example, buy to let. You are buying to let it out. It's like your business. Then you can't get a letting relief. So letting relief is the lower of these 3 things. The gain that is attributable to the relevant period of letting, the gain already exempt under PRR rule, and 40,000. Because you have to calculate the gain exempt under the PRR rule, you have to calculate this first. So any remaining gain not covered by PRR exemption or other relief, they will be subject to the tax at the higher residential rate, 18 or 24% according to the taxpayer's level of income. Now, activity 5. So now we will be calculating PRR with letting relief. Here again on 1st June 2005, Prince have 80,000. He sold for 285 on 31st May. On 1st June 2013, he started renting out 1/4 of his house until this date. So calculate gain on the sale of the house. Let us do that. So activity 5, As I told you in activity 4, we need the 5 columns. So this I've copy pasted from activity 4. Now, so from 1st June 2025, sorry, 1st June 2005 to 31st May 2013, I will just change the year. Actual occupation. So actual occupation is counted as exempt. This we know. So 2013 to 5, how many years? Calculate from 5 to 13. 8 years. So 8 into 12. 96 months are exempt. So here it is just use the function so it's easier for you. Okay, now 1st June 2013 till when did he let it out? 31st May 2016, right? So now how many? 3 years. 3 years means 36 months. But when you are taking 36 months, remember there's a letting period. Okay. So on 1st June, Prince started renting out 1/4 of his house. 1/4 of his house he has started renting out. So the renting out part will be chargeable. But the actual occupation will be exempt. That means 3/4 will be exempt, 1/4 will come under letting of property. So this is let 1/4. Okay, which will be taxable. So when you are taking it, it is 3 years from 2013 to 16. 3 years means 36 months into 1 divided by 4, 1/4. This is taxable. So the 9 months are taxable. Just use the sum function. Done. Then in this period, the actual occupation will be exempt. What is the actual occupation? The remainder. Okay. So I will just add one more line here. 3/4 actual occupation. So just take 3/4 of 36, or just simply take 36 minus 9 is 27. Okay. So 27 is exempt and 9 is taxable. Now from 1st June 2016 to 31st May 2024 is the actual occupation. So that 9 months comes inside the actual occupation. Since that entire actual occupation is exempt, that last 9 months comes inside that only. So you don't have to take it separately. Because the last period, it is actual occupation. If he have been absent, then the last month we would take separately. But since he's not absent here, so from 16 to 24, 8 years, isn't it? So 8 years exempt. 8 means 8 into 12, 96. So the total is 219. Okay, 219, which is exempt, taxable is 87. Now, so it has been sold for 285. Just change the sale proceed, and the cost is 80,000. So from 50, just change 80,000. And now we have a letting period. Remember, that is additional, but the PR exemption as it is we can deduct. How? When you're taking the PR exemption, it is the exempt and the total. This part is correct. but it's on what? The gain. So 196,908, that is your PRR. That's correct. But now, since you are letting it out, letting relief is the lower of three things: 8092, 40,000. Sorry, PR exempt. This thing is this, okay? Not the gain. It's 196,908. This is the PRR. Okay. The lower 40,000 is lower. And what's next? Letting gain. Okay. So letting gain will calculate. How many days was let? Only 9 out of the 288. So here on this 205, the gain, multiply the letting period, which is 9, divided by the total. So just drop down the list. It's the same as your chargeable gain, 8092. So which one is lower out of this three? It's 8092. So the entire thing is reduced by the letting relief and you are left with 0. No chargeable gain. So this is the answer for activity 5 with the letting relief having chargeable gain of nil. Now the third part to this, business use of home. So when we are using our home as a business use, remember PRR is restricted to the residential use. Business use, PRR is not available for the business use part. So exclusive use means part of the house which is set aside for business use. So the deemed occupation rules do not apply to the part of property that is used for business. Remember this. This deemed occupation will not apply if you are using it for the business purpose. If the part of the property was always used for business, then the last 9 months ownership rule will not apply to the part of the property used for the business. Remember that last month exemption that you used to get, always you will not get. However, if for some time the property was used for the business, then the 9-month rule will apply to the whole property. That means at some time that house, that property that now you're using for business purpose was your main residence. You have used it as a main residence. Now you're using it for a business purpose. Then that 9-month rule will apply to the whole property, not the business use or the main residence portion. So activity 6. Now we are going to calculate PRR with partial trade use. Here, Amner sold his house on 30th June 2024 for 355. He purchased the house 1st May 2005 for 60. So between 1 May 2005 to 30th April 2012, whole house was private residence. Between 1st May to 30th June, it was used for the workshop. 10% of the value of the house relates to the workshop. Calculate the chargeable gain arising on the sale of the house. So here, from activity 4 and 5 I brought forward this answer, copy pasted it here. I'm just going to change the figure in this table because this is common for any PRR. So now calculate the PRR. So from 1st May 2005, just change the month. 1st May 2005 to 30th April 2012. How many months? 7 years. 7 years means, so just change this to 7, 84 months. Okay, 84 months, actual occupation exempt. Next, first May 2012 to 30th September 2000. Okay, 30th September 2023, partially exempt. Here it is partially exempt, and last 9 months will be always exempt, which is 1st October 2023 to 30th June 2024. See, in case you want to find the last month and you don't know the starting date, 1st October, it's 1st October here, right? Go backwards. In that case, go backwards. So 30th June 2024. Then go back 9 months back. Okay. So the whole month of June will be taken because this is the end of June. So you go back till you land up 9 months before, which is 1st October. October, November, December, January, February, March, April, May, June. 9 months. Okay. So now this period, it is partially exempt. So we have to calculate. It's from May 2012 to 2023. First calculate from 12 to 23. How many years went? 11 years. Okay. And with 11 years, it's May to September. So May, June, July, August, September. Another 5 months you have to add. With 11 years, okay, so it's here the total. 11 into 12. With that, we'll be adding another 8 months. You have to put bracket so that multiplication is done separately. May, June, July, August, September. Another 5 months. Sorry. So it's 137 and the total is 230. Now, so 10% house relates to the workshop. That means 90% it will be exempt, right? So if you see here, what's your gain? You have already calculated the gain? No, you haven't. So first we'll calculate the gain. It is 355. The proceed. Then from there the cost is 60,000. So 295 is the gain before PRR. Okay, now so between 1st May to 30th June 2024. So this 137, okay, we have taken it. Now first let us find out the 100%. Okay, if you want to find the PRR, it is this, multiply the exempt, which is 93, divide by the total. Okay, just drop down the decimal. So it's 119,283. Now with this 295, another relief will be added when it has use for the business purpose, the trading use part. So the private part you can claim a relief on that 295 into 137. This is the total. Divide by 230. So when you're taking this, do not forget to take 90% of this value. because when it was used as a main residence. So into 90%, which is 158,146. Now the total will be your PRR. 90, on the 90% during this period, okay, you are not absent. You will get the 90% of this 137. You are going to get exempt. Okay, the remaining 10% will be taxable. So this is your PRR. Now you are going to take this as your PRR. Just put a minus and click this figure. Automatically this answer will show as a minus figure. Now, so this is your chargeable gain that is attributable to the business use. So the answer for activity 6, the only addition here is, here we are taking 90% for the private use and adding it together, and this is the PRR. Now, so with that we have finished PRR. Now we have moved to the last part of this lecture, the third part, which is the last part. That is for your lost or your damaged asset. When your asset, there is a loss of your asset, how do you deal with it? Loss of an asset means that asset is your land, could be your building or chattel. Okay, and you're not receiving any compensation. So the loss without compensation arising results in a disposal at that date and establishes a loss. So when you are doing a disposal, it is treated as it's at a loss. Now the loss with compensation, that means you're receiving a insurance proceed. This will result the disposal at the date of receipt of this capital sum, and usually it's a gain. That means when you're receiving an insurance proceed, that loss will be taken as disposal at a gain, and that disposal will be at the date of the receipt when you're receiving the insurance proceed. That is the day when it is taken as a disposal, and when you're not receiving any compensation from insurance, it will be treated as that disposal is at a loss. Now if the proceeds that you have received, the insurance proceeds you have received, are not reinvested in a replacement asset, then the gain is calculated using the normal CGT rules. If you are not reinvested, calculate CGT. And if the asset is destroyed, if the asset destroyed is a non-vesting asset, for example land, buildings, chattels such as jewelry, and the compensation, insurance compensation you received, you have reinvested. So in this first case, you did not reinvest, so calculate CGT. Normal gain CGT. But if you have reinvested the proceeds that you have received when the asset got destroyed, you received compensation. That compensation you have reinvested. That means you have bought another asset using that proceed. You have reinvested in a replacement non-vesting asset within 12 months of the receipt. Then you can make a claim to defer or rolled over your gain. That means you're not calculating the CGT now. You're deferring the gain later. So the assessment deferred until the later disposal of the replacement asset. When you sell off that replacement asset, that time you have to pay CGT. Okay. So now, what happens if the proceeds that you are receiving from insurance, you are only partially reinvesting, not the entire amount? Then some of the gain will be chargeable now, some will be deferred. What is chargeable now is the proceed that you have not reinvested, and the balance rolled over. See example 5. This claim to rolled over have to be made within 4 years of the end of the tax year. And if it's companies, remember for companies also there's a rollover relief. For them, it is not the tax year, they go by the accounting period. So for them, 4 years from the end of the accounting period. So end of the tax year in which the capital sum was received, within 4 years from the date you have received your insurance proceeds. the cost of the new asset for the future disposal purpose is reduced by the gain rolled over. Remember, when you're buying the new asset, replacement asset is your new asset, right? That cost will be reduced by the gain rolled over because you are rolling over the gain, no? So the gain that you are rolling over, you have to deduct it from the cost of the replacement asset. That means the cost of the new asset will be less when you are selling it in the future. So that means in the future you are paying a heavier, your gain will be more because your cost is less. If you are deducting a lesser amount from your sale proceed, you are going to get a higher, greater amount of gain. Higher amount of gain means you have to pay higher CGD. So in short, even though now you're not paying, you're not actually saving anything. It's just you are going to pay in the future. But that amount will be taken in the future by deducting the cost. So example 4. Here Julio is purchasing an antique chair for 20,000. Chair got destroyed. He received compensation 25. And he purchased another chair at a cost of 26. What happened? He received 25 but he invested 26. 1,000 more he invested. That means the entire amount of insurance proceeds is used to buy this antique chair. The whole amount is reinvested. So that means the whole amount will be rolled over. Okay. Now, so we'll calculate the base cost of the replacement chair. That means what will be the cost of the replacement chair now. So first cost of the chair is 26,000, right? Now less the compensation. So from compensation we deduct the proceed of the old chair. Compensation was 25,000. How much did you purchase it for? 20,000. So 5,000. So this 5,000 is the deemed disposal proceed of the old chair, which you will deduct from the 26,000 because this is the amount you have reinvested. So base cost of your replacement chair is 21,000. There is another way of doing this, which is much easier. It is you have invested 25,000, proceed of 25,000 from insurance company, right? You have invested the entire amount. So the entire gain will be rolled over. First find the gain. Once you find the gain, that gain reduced from the purchase price. Simple. Which purchase price from 26,000? What is the gain? 25. So that's what they have done. 25,000 compensation. This is taken as your sale proceed now. What is the cost of your old share? 20,000. So gain is 5,000. This gain was not taxed. It is rolled over. So this gain you will deduct from the replacement chair, which is the new chair. The cost of the new chair. The cost of the new chair is 26,000. From there you will deduct this 5,000 gain. And base cost is 21,000. I'm sorry, there is no other way. This is the way. The only thing is, in terms of sale proceed, they have used compensation, okay, and the cost. It is known as base cost. Now, so whenever they say base cost, this is the meaning. Deduct the gain from the cost of the new asset. Example 5. Partially they have reinvested, not the entire amount. This case is different. Here Anna is purchasing for 40, received 50, buying another for 48. What happened? He received 50 but buying at a less than the insurance proceed, 48. You see? So first we'll find the gain. Insurance proceed is 50. From there we'll deduct the cost. This is the gain 10,000. Remember, 48 was reinvested but he received 50. So 2,000 was not reinvested. That 2,000 is chargeable. First find the chargeable. This is the balancing figure. So because 2,000 is chargeable now means 8,000 will be deferred. So this 8,000 will come here and you will deduct it from the new cost. Cost of your new ring, that is 48. So 48 minus the gain, this is your base cost. If you see, this base cost is exactly the same as your cost of your old asset. The first ring, 40,000, you see. Now damage to your non-vesting asset. The next part. First, it was loss or destruction, now damage. If your non-vesting asset is damaged, it's not a disposal unless you are receiving a compensation. You have to receive a compensation for it to be treated as disposal. So in which case a disposal arises at the date of receipt of the insurance. Now when a disposal arises, allowable cost is calculated using part disposal formula. Here when it's damage, remember part disposal comes with the damage, not loss or destruction. Okay, if you remember this, it's easier for you. So cost into A divided by A plus B. A is the compensation received, B is the market value of the damaged asset. Remember, in terms of damaging of the asset, your A changes, B also changes. When it's a part disposal of a land and building, then it's different. A and B accordingly. Okay. So now, if the compensation received is applied in restoring the asset, now you are trying to restore the asset back to its original position from the compensation that you have received, then taxpayer can elect the situation not to be treated as a part disposal. Okay, same way in the previous one for loss and damage. When you're receiving an insurance, reinvesting it, you're deferring the gain. No gain are calculated. Here also no part disposal. So what happens? The compensation that you have received is deducted from your CGD cost of the restored asset. So the assessment is deferred until a later, when you dispose of your restored asset later, then the gain comes. Now, this claim also 4 years from the end of the tax year, and for companies is accounting when capital sum is received is the same. If no claim is made, okay, or if the proceeds are not used in restoring the asset, then normal part disposal calculation you use to calculate the gain, and the part retained is the value of the asset in its damaged condition. Remember, the part retained is the value of the asset in its damaged condition. So example 6. Now, so we will be solving example 6 now. 3 situations are given. Okay, so Nisha purchased an antique table for 15. It was damaged, at which time it was valued 25,000, but after damage it was valued 19,000, even less. Insurance proceed received 20,000. First situation, proceed not used to restore the asset. So normally you will calculate the part disposal. Okay, so that means there will be a gain. So what is the insurance proceed? 20. Then the cost. What was the cost? 15,000. Then after damage, before damage. Okay, so A is insurance proceed 20 and 20, and you need to know the value after the damage, which is 19,000. That's your B. So that's your cost, deduct, and this is your gain. Finished. Second situation, you use the proceed to restore the table and the claim made for no part disposal, and table is sold for 30,000 later on. What happened? So according to the second situation, remember the gain is deferred, no part disposal. So what is the original cost? Originally you bought it for 15. You deduct your insurance proceed. Then you add the proceed that is used to restore the table. So this is the base cost of the restored table. In short, from the insurance proceed, deduct the cost. Insurance proceed is 20,000. Original cost is 15, which is 5,000. This is the gain. Okay. So this 5,000, you're deferring it. It's a gain. Deduct it from the cost of the replacement asset. So restore the asset. So now you have used the entire proceed 20,000, right? So this 20, from this 20 that gain will be deducted 15,000. So if you're understanding this, it's fine. It's the same thing. It's just they have changed the order, okay? Rather than doing it in one shot, I've taken the gain first and deducted from this 20,000 and got this 15. Now, so he's selling it for 30. So from 30, remember this base cost, this 15 you will take, and this would be the gain. When in April 2025 you are selling. Third scenario, proceed used to restore the table. That means the entire procedure using. But no claim made for no part disposal and table sold on 1st April for 30. So now if Yusha used it to restore the table but did not make the claim, there will be no, there would be a gain. Okay. So in this case, this gain is there, no claim is made. In this case, claim was made and claim made for no part disposal in this case, but no claim made for no part disposal, no claim made. This line is different, except this line, everything else is same. No claim made means part disposal is there, even though it was used to restore the table. He did not make the claim means it will follow the part disposal. So now 30,000 is the proceed. From this 30,000, remember the original cost 15. From this 15, this gain will be deducted, base cost, and then the restoration cost 20,000. That is your insurance proceed. So this will be your gain. 2692. Here the gain was 15,000. This is the difference between the second and the third scenario. There you made a claim for no part disposal. Here you did not make a claim for no part disposal. So it will be treated as no part disposal because you did not make the claim. So if you see the overall gain under second and third, okay, if you add this to 12,308 and this one, it would be 15,000 only, regardless of whether a claim was made. But if you see whether you make the claim or not, difference does not occur. Difference occurs in the timing. Timing of the gain would differ. If you see majority of the gain being made earlier in the third part, if you see it's 12,308, majority of the gain are made earlier. This is what happens when it's a part disposal. But if you're claiming for no part disposal, then the entire 15,000 is once you have to pay. Now, moving on to activity 7. So this is about Stephen having a warehouse. The warehouse was destroyed by fire, insurance was received, so amounts are given. This is the cost, this is the market value at the date compensation received and compensation received. Assuming 130 was used to replace the warehouse, calculate chargeable gain. At the date compensation was received, indicate the future CGT cost of the replacement asset. So now we will be finding the gain, which is 145. So proceed is 145,000. That is the compensation received. Okay. Then we will be deducting the cost of building. But here, this is a part disposal. Remember, this is destruction of a non-vesting asset. So this is not lost or damaged. This is destruction. So part disposal will come here. Okay. So here it will be treated as a part disposal. So we need the cost of building. Now, cost is 119,440. So here when you are deducting it, equal to minus 119 is given already. 440. Cost is given. Multiply this with A divided by A plus B. What is A? A is your insurance proceed. Divide by A plus B. Again A is your insurance. Plus B. What is B? Market value of at the date compensation received. That is 59,000 in this case. So we are going to drop down the decimal. Always work in whole number. It's easier. So this sum function, and then we'll get the total. $1,604. Now so we have to see whether we have anything rolled over relief or not. Okay. So what is the proceed? If you see, the proceed is 145. Okay. How much did you use from 145? You used 130. You did not use the entire compensation. How much you did not invest is your gain. So 145 you have used versus 130. So the difference is 15. 15,000 is rolled over relief. Okay. So 15,000 is your rolled over relief, means 15,000 gain. This is your chargeable gain. The difference will be a chargeable gain. So this is the balance. Okay. This is a rolled over relief. Rolled over relief means the one which is not chargeable. So now, first one you have answered. Second, future CGT cost. So future CGT cost, where you are writing, okay, what is your cost? 130,000 you used to replace, right? 130,000. From here you will deduct this rolled over relief minus this. So if you take it, the sum function, it is this. Now this is the building cost, but what about the land? See, that cost is including land. Okay. So now this is the cost of the building. So if you want to take the cost of the land, just it's 119,440. This includes the cost of the building also, minus this. So this two, if you add, this is the cost of the land, this is the cost of the building. You see, this is equal to your cost of your original warehouse, 119,440, if you see. So your future cost of your replacement building is the same as your original cost of the warehouse. Now let us move on to activity 8. Here it's a damage to non-vesting asset. Here also compensation received, everything is given. Here it's 160. Same question. Okay, and future CGT cost, but 160 is used. So now here we'll calculate the gain first. Okay, compensation received. So first is your proceed. Proceed is your compensation received, which is 160,000 in this case? Yes, 160,000. Now you are going to deduct the rollover relief. So here, if you see, compensation relief is 160. You are using 160 to restore the shop. Entire insurance proceed has been reinvested to restore. So the entire amount, so your rollover relief is 160. One additional zero, okay? Rolled over relief. So here you have zero. Nothing is taxed. No gain, no loss. Now, in future, what is the cost? Original cost 135. 135 is the cost. With this 135, okay, add the cost of restoration, that is 160. And then deduct the rollover relief. This 160 is this 160 compensation received. So from here we are going to deduct the rollover relief. So at the end the cost would be what? 135,000 only. This would be your cost. So this is the answer for activity 7, where we have got this, the base cost of the replacement asset, as the actual cost of the old asset. This is the beauty of rollover relief. Okay, and here since it's partial, you did not replace the entire insurance proceed, you did not use to replace, so partially you will be taxable and partially rollover relief. But in activity 8, 160 was compensation received, you have replaced 160, so nothing is taxable now, everything is rollover relief. And here also this 135 is the same as the original cost of the building. Now, so that's it. The syllabus area that we have touched on this lecture is section C, and here the second part, computing gain and loss. So understand the allowable expenditure for a part disposal, that is the fraction, cost into A divided by A plus B. Then recognize the treatment when the asset is damaged, lost or destroyed. And also for the insurance proceeds, reinvesting and not reinvesting or partial reinvestment, the three scenarios. Then gain and loss when you're disposing a movable or immovable property. Identify chattels and vesting assets are exempt. You have to identify when they are exempt. Okay. Compute the chargeable gain when a chattel or a vesting asset is disposed. Calculate the chargeable gain when a private residence is disposed. Vesting assets are exempt from CGT. Chattels are your tangible movable property. They are exempt from CGT if they are your vesting assets, cars, cost and current market value less than 6,000 or do not qualify for capital allowance. Gain and loss that arise on disposal of non-exempt chattel depends on the relationship between your actual sale proceed and cost. That 6,000 limit. Remember the four scenarios where both proceed and cost are more than 6,000, less than 6,000. One is more than 6,000, the other one is less than 6,000, like that. And for CGT purpose, land and buildings are treated as single asset. So the gain or loss on a part disposal is based on the attributable cost of that part. The attributable cost of a part disposal is calculated using the formula cost into A divided by A plus B. A is the gross consideration. B is your market value of the remainder of the asset at the date of part disposal. But when insurance proceeds are received, A is your insurance proceed. Then your main private residence could be exempt based on the conditions of occupancy. Last 9 months are always exempted, and actual occupation is also exempt, and then there are some deemed occupation. 3 scenarios are given there where deemed occupation is taken. But if deemed occupation is there, you have to stay before the deemed occupation and after the deemed occupation. So private PRR is calculated into, first calculate your gain normal way, then take that gain, multiply it with the period of occupation, divide by total period of ownership. Remember that 5 columns we did the table, exempt months, taxable months, total, that's how you have to do. Then a taxpayer with more than one home can elect within 2 years which one should be treated as their main residence, as there can only be one main residence, not two at the same time. And any part of the home that is used for the taxpayer's business, you cannot exempt it from CGT. No PRR applies there. When your non-vesting asset are being lost, you are not receiving a compensation. Then it is taken as a disposal with a loss. When you are receiving a compensation, it will be taken as if it's with a gain, and that gain will be rolled over if you are replacing it with a non-vesting asset. But if you're not reinvesting in full, you're not going to get the entire relief. That relief will be reduced. And the gained rollover relief reduces the base cost of your future disposal also. We have seen that. And when your non-vesting asset is a damage, again when you are receiving a compensation, okay? If you are using the compensation to restore the asset, the same amount, no gain, no loss disposal. And same like loss of asset, the CGT cost of the restored asset is reduced by the rollover relief. So in this area, there are one technical article you have to read, that is chargeable gain part 1. But there's a chargeable gain part 2 also. If you want, you can read it. It's there for my previous lecture. And also higher skill technical article is there. So that's it. Thank you for watching, and I shall see you in the next lecture. Next lecture is also going to be a very interesting lecture and a very important lecture, because next lecture will focus on shares, CGT on shares. When you're disposing shares, how capital gain tax is calculated. This is focusing on your chattels and vesting assets. That one will focus on shares. So if you haven't subscribed to my channel, do subscribe, and also under my tax playlist watch my other lectures as well. Thank you.